Another seminar of our weekly seminar series. Today with us we have Keith Baker, and we will be talking about due diligence and how to avoid mistakes in that, a really important topic. So excited for this today. I am Nicole Bako, an IRA specialist here at Quest Trust Company. Moderating for us today is Juan Deshawn, another IRA specialist here. But before we get going on our amazing presentation, I just have a few slides to share with you to tell you a little bit more about who Quest is and what we do. All right, it should be on the right one. Is it on the right one?
Yes.
Awesome. Okay, good.
You're good, Nicole.
All right. So thanks for joining us. So who is Quest and what do we do anyway? So Quest Trust Company is a self-directed IRA custodian out of Houston, Texas. It was started by two brothers, Nathan and Quincy Long, who started the business as investors and built it around the client experience. We've been around for a while, so very experienced in what we do. We have offices in Dallas and Austin as well. We do have 20,000 active investors across the country. So no matter where you're joining from right now, we'll be able to help you. Let's see. Oh, of course, our disclaimer. So this webinar, like all of our webinars, is for educational purposes only. Please do your due diligence like we'll be talking about today. We want you to make sure you're getting in touch with your CPAs, your attorneys, doing a lot of research before you get involved in any investment. So great topic today for our disclaimer. So what is a self-directed IRA anyway? So self-directed is honestly just a marketing term. An IRA here does the same thing as an IRA anywhere else, governed the same way, same contribution limits. But at Quest, we hold private investments and we have a platform to do so in holding alternative investments. So that's the difference, of course, at Quest. So why should you have one? Diversification. So as opposed to just being in stocks, bonds, mutual funds, in the stock market, here you can invest in private assets, real estate, promissory notes, etc., diversifying your portfolio. The tax savings. We have tax deferred and a tax-free account, the Roth IRA that I'm such a big fan of. Of course, all of the accounts have their own special type of tax savings, so make sure you're getting in touch with your IRA specialist to see which one is really good for you. Social investing. Most people are actually building or improving their own communities or close to them, which is really nice. There's not everybody that can get a traditional mortgage. So doing like a seller financing is really helping the community. So that's important. And then, of course, invest in what you know best. This is your time to shine with the education you already have. So if you're already really knowledgeable about real estate or oil and gas or notes, etc., this would be a great place to show that knowledge. So these are our 7 accounts here at Quest. I'd love to tell you more about all of them, but just don't have time today. So make sure you get in touch with us, even if you're a current client, to see if one of these fits for you. These are our 3 main asset classes at Quest Trust: real estate, promissory notes, and private entities. But honestly, I would say that this is a short list. Oil and gas is something that you can invest in as well. So make sure, again, you're getting in touch with your IRA specialist. Our client portal, we are so proud of. So once you become a Quest client, you can honestly do everything from the portal. You can now submit your investments, your fair market value documents, manage the whole thing. So we're really excited about that. And of course, we offer endless education, just like the weekly webinar series we do here. And I would like to take this time to tell you about an exciting event at each one of our offices coming up. Now, these are limited to 50 people, so get your tickets now. And if at the last minute you have to cancel, let us know so maybe somebody else can get in. Of course, we're doing these virtually as well, so we'd love to have you join us. We have additional classes, of course, our weekly classes, the self-directed Saturday. We'd love to have you join us for our virtual networking happy hour when you can connect with investors all across the country. We host that event the first and third Wednesday of every month at 6:30 Central. Of course, our YouTube channel has all of our webinars. It's live streaming right now. You can find all of our past webinars there, as well as other information about self-directed IRAs. Our promotion this month is rewards for deposits. So if you can see the qualifying deposits on the right and the fee credits that will give you on the left. So current client, new client, make sure you let us know so we can get you this great reward. All right, how to get in touch with us. We're very easy to get in touch with. So the QR code actually works right there. You can chat with us live on our website. It is manned by IRA and transaction specialists. We're not robots. I get that question a lot. We'd love to chat with you. Of course, call us 855-FUN-IRAs. We really do think this stuff is fun. We think this is really exciting. We'd like to share that with you. Or of course, email us directly. You see my email and Juan's email there at the bottom of the screen. Okay, that is quite enough from me. It is time now for our guest of honor, Mr. Keith Baker. We are so excited about this topic today. Please take it away, sir. Oh.
Keith, you're mute right now.
Am I muted? I'm sorry.
There you go.
There we go. So thank you very much. I apologize. And I should be sharing my screen so where everybody can see that. Okay. Well, thank you for that great introduction. I don't think IRAs are boring at all. In fact, they can be quite exciting, and we'll talk a little bit about that today. Today's topic is common due diligence mistakes and how to avoid them. And essentially what I've done is put together sort of my mistakes that I've made over the years, as well as the mistakes that others have made and they've shared with me, and sort of brought them down into this category of 10. And I know we're live, so Nicole, Juan, if anybody does have any questions as they come up, feel free to, we don't have to wait until the very end. I would love to do a Q&A, but if something needs to be defined better or discussed a little better as I go on, please let me know, and we'll try to get it taken care of in real time. Otherwise, we'll just do the Q&A at the end. So, all right. So a little bit. Why listen to me? I am a private lender. It's my preferred method of real estate investing, and I got into it rather by default because I have a good day job. I still have a good day job, but I wanted to be a passive investor. And after trying to be a landlord and finding out that I was a pretty lousy one, and missing the gas company for the third time when they were trying to connect so I could get the gas, so I could get a tenant in the property, I pretty much decided that private lending would be my one and only, my main vehicle for real estate investing. And I became a Quest client in 2009, although I believe it was called Entrust back then. But I am forever grateful to Quincy and Nathan and everyone over at Quest, because my education began at Quest. It continues at Quest, and now I'm able to give back and do webinars. And they always, the biggest advantage Quest has over anybody is they just give out tons and tons of education and answers as many questions as they can to their clients and not even, and people who aren't even their clients. So great organization. And I'm very happy to be here and grateful to be on today's webinar. So again, I started mostly single family, sort of the hard money short term. I then drifted over into owner finance wraps. A friend of mine who I became a partner with real estate, he was a student of Mitch Stevens, and learned that whole owner finance and wrap methodology, to Nicole's point of giving mortgages to people who are unmortgageable. I have dabbled in second position liens. They can be quite profitable. However, I do recommend people stay away from them until they have a lot of first position liens under their belt and really understand the mechanics and more the risk of what a second position lien can bring you. But now in my personal investing, I'm starting to, given the recent craze in the housing market, my last two deals have not been single family, but have actually been a commercial building in Houston, and then multifamily syndication and two apartment complexes down in Victoria, which is south of Houston. But I'm still a single family at heart. That's sort of the bread and butter. It's what I'll be talking about today. And for myself and deals, I've looked over 1,000 deals for myself and others through the course of the years since becoming a Quest client. I do now. I do some coaching. I also have the private lender podcast where it's free, and I talk about very much the same things that we're talking about today. I also bring private lenders on to talk about their experiences, what's worked, what hasn't worked, where they made mistakes, and also bring on other professionals such as self-directed IRA custodians like Quest. I've had Nathan and Quincy on, and we'll be, I believe Derek will be on shortly, talking about some rather interesting deals and things that have come across the desk over at Quest, odd deals and whatnot. But started the podcast just to share the education. Also have Private Lender Academy where I do the coaching, and this comes from I noticed that there are a ton of gurus out there who will tell you how to raise private money, how to find a private lender, but nobody was telling these prospective private lenders how to stay safe or what they needed, how to identify risk, how to avoid it, and more importantly, how to mitigate it. And so that's where I saw this niche. And since, Quest is bound by the IRS and other entities of, they can't provide legal or, investment advice, I can, I've dedicated it, the podcast and the academy to helping private lenders stay safe so that they don't become a statistic or a horror story at the Quest Fright Night. That's sort of my goal, to prevent that. Not to take anything away from that awesome function in October every year, but to try to make it so where as few people experience those catastrophic losses or those losses. Period. I do teach my mistakes and my losses, so I try to be very transparent of where I have messed up, so to speak. And as we go through today's presentation, I will give you some examples of when I didn't even listen to my own advice. So hopefully you'll benefit from that. So let's get right into it. The first mistake I've noticed and I suffered from was I didn't believe that I could do it. I knew it was possible. I knew that there were places like Quest that allowed for promissory note investing, for real estate investing in private entities, but I didn't feel like I had the wherewithal to do it, which is a really bad limiting belief right out of the gate. So rather than this being a rah-rah into you can do it, because anybody can, just focus. What I thought I would do is make a comparison back to the banks. In essence, private lenders do exactly what the banks do. The only difference is if we get $100, we can only loan out $100 of our own money. Banks have a factor where they can loan it out several times. Hence, they are an extremely profitable business model. And that's why you see their names on some of the largest buildings in town, any town in the United States, but also on sporting venues, concert venues and whatnot. They do a lot of advertising, and it's because of the lending model that allows them to do that. Of labor statistics, and this is for a loan officer at a bank, someone who handles, and this is just residential mortgages. This isn't necessarily hard money or the private money investment loans. This is just straight up mortgage officers. High school diploma or equivalent. The bachelor's is often preferred. Often is interesting because it's not mandatory. You don't need a degree to do this. You don't need a degree to do private lending. They do have degree fields that they like to see. And that you do have to have a license, which is pretty common sense. Answer some, study, answer the questions. A good experience of 2 to 5 years. And the key skills is what I really wanted to hone in on here. Is good communication, interpersonal skills, and making skills with a knowledge of mortgage, loan, and financial institution policy and procedures. Basically, they train these people they come in as a teller, and as they move up, they're put into these positions. It's not, you don't need a degree from Wharton, or you don't have to have the last name of Trump in order to do this. It can be done. And a pretty decent salary for 2018. I don't know if that's starting out or if that's a seasoned loan officer, but the point being from this slide here is to put it in black and white that this is definitely, it can be done. And if you have any questions or any fears, that's what Quest is great at. They're here to help you, get beyond that to make sure that you don't, from their standpoint, that you do everything above board, legal and compliant. And then folks like myself come in and, if you have questions, should you do a loan or is this too much risk? Happy to help you guys out there as well. And we'll get to some of contact information later on. So that's mistake number one, is just the simple belief that you can't do it, or you don't have enough. It's just not the case. We'll say anybody can do it. Anybody with focus and some commitment to learning can absolutely do this and do it safely.
Hey, Keith.
Yes.
So, you said to interrupt for a quick question. I think it relates to what you're talking about.
Sure.
Someone asked, how much money do you think they should have available to get started to private lending?
Good question. Obviously, the more the better. So there's one downside to private lending, and that's you're going to run out of your own money at some point. So I like to keep it active and to work in the Houston area. I would say 100,000 would be a really good start. 150 would be even better. However, you can come in and I've done loans on properties for as little as $23,000 that were turned around and used for that were sold with owner finance. So the short answer is the more money you have, the better. However, if you don't have a lot of money, it still doesn't knock you out of contention. It sort of limits what sort of deals you would be able to do. Obviously, not going to be a whole lot of flips for $25,000, for example. Your 100 to 150,000 would be more apt for those types of loans. Also, if you don't have a lot of money, if you have, say, less than 50,000, you can do sort of renovation loans, where if somebody has a house that's already owned free and clear, but it needs a new roof and air conditioner, for example, it's a rental, then as long as there's a first position lien on that money, then I would say, yeah, you could loan it to that landlord if the terms are agreeable to you, so that they can fix up the property and keep it cash flowing. And those are just a few examples of not having a whole lot of money, but obviously the more the merrier, so to speak. Any other follow up with that one?
No, I think that answered the question.
Okay.
Have you ever seen loans? Have you done loans with someone else before, like to make up more capital?
Yes. So in addition to, you can also, if you don't have, that's a good point. Thank you. Yeah. If you don't have a lot of capital up front to say fund a full rehab purchase and rehab of a flip property, you can team with other account holders, other people. You just need to get make sure the paperwork is vested properly, and that's where Quest will come in and help out a lot with that. But make sure the paperwork is correct. But you can partner with other lenders on a note. So if you don't, if you have, say, 30,000, and if you have four friends that each have 30,000, then there's a $120,000 potential loan that can be actioned just through partnering. Okay, let's move on to the second mistake, is trusting the borrower. And I'm not sure if anybody can see me, but one of my hashtags for the podcast is never trust, always verify. And this is where I've gotten in trouble. It's sort of a double-edged sword. The first private loan I made, I did all my due diligence as best I could. I talked to some folks at Quest. They, things looked well, they looked good and compliant, but I still had that nervous, that doubt of pulling the trigger on the loan. And ultimately I trusted the borrower, and everything worked out for me. He paid as agreed on time. And then I was refinanced out after I believe it was about 6 months, and it worked out perfectly. And it got me, got my first win under my belt, and I went on to do more and more loans and come to where I am today. I've also trusted friends of mine who were the investor, the borrower, and I did not perform my due diligence because, well, this is a friend, right? I don't need to. Wrong. I implicitly trusted a friend in a second position, and that is how I can tell you is the fastest way to lose. I lost $18,000 out of my Roth IRA because I trusted a borrower that was a friend of mine. So that is one of the mistakes that I've put up. It should be number one, but I thought a limiting self-belief would be more important than number one. But yeah, never trust, always verify. And that goes for the after repaired value. Look, real estate investors are very enthusiastic, if nothing else. And especially with the current market, retail housing market that we're seeing right now, I'm not trusting anything that a borrower would bring to me. I want to see sort of current MLS listings or sold comps, which are in my book inflated, but I'd also like to go back and look at pre-COVID comps just to see where that market was, wherever that house is. Not that I'm going to base my everything on that. My ARV wouldn't necessarily be based on pre-COVID numbers, but I want to see it myself rather than just take the word of the borrower for it. Again, okay, and if there's a question, get an appraisal. Absolutely, I do my own comps. I'm confident enough that I've seen enough deals that I feel like I can comp a property fairly well. But the beautiful thing, banks don't do that. They use an appraiser. They rely on an appraiser to get a evaluation of the property and what they're going to loan on. So I would highly recommend anyone doing the same thing, especially if because of the current market conditions, if there's any questions or trepidation beyond that. Yeah, I don't like verbal rehab budgets. I like to see written out scope of work. My day job is an insurance adjuster, so we're quite used to seeing a scope of damage, the work that's going to be needed, in paper and hard copy. I like to see the same thing. I like to know if there's a general contractor. I'd like to see what their budget's going to be for a rehab. If the borrower is going to be the general contractor, I like to see the quotes and bids from the electrician, the flooring people, the roofer, so on and so forth. And I also like to go look at the properties myself. That is one of my big things. That's why I like lending local. I don't necessarily lend across state lines. One, because I don't have to. There's plenty of action here in the Houston area, and people know about. It's what, the fourth largest city. So it's very easy to find deals in this area. But I like to go to the property. I like to see it, touch it, smell it, and look and see what the condition is, and can compare and contrast that with what is that rehab budget? What does that scope of work look like? And does it seem like it's a very heavy scope of work for a little bit of money? Because that can be a red flag that the borrower is already in trouble. So I don't trust them. Go to the property and also look at a hard, firm written estimate. Oops, sorry. Let me jump back real quick. So that's, trusting the borrower. It's, especially when you're dealing with friends or family, that can make Thanksgiving very interesting if something goes bad. But if you just jump right out of the gate and not trust anything they say, or just, confirm everything, make sure that everything that they presented is valid and is confirmed. Maybe the ARV that they've come up with is realistic, and there is a contingency in it. I know we're starting to see some signs of banks tightening up, and the housing market might be cooling down just a little bit. I'm not saying gloom and doom, just it's not the robust pace that it was. So there could be your borrower may have their finger on the pulse of that property and that market to a T, but it's something that you'll need to verify and confirm yourself. The third mistake is not demanding the borrower has skin in the game. And this is where I anger a lot of investors, because they want to come in with no money down and no skin in the game, and to be able to walk away from a deal if it goes bad. And since we're talking about retirement money and our futures, I try to dissuade folks from those types of deals. And there's always a caveat, but I'll give you an example. If someone comes to me with, a loan that's going to be 70%, we're at 70% loan to value with rehab, or 75, and they don't want to put any money down, I'm not going to accept that deal. They're going to have to come up with points. They're going to have to come up with closing costs. They're going to have to come up with something if there's not that much margin, in that deal. Now, I have done deals where the borrower has done just that, has absolutely no money down outside of a deposit to some earnest money to the seller. But we're talking LTVs at 30%. So there's 70% cushion if something goes wrong. That's a heck of a margin for me to be able to recover my losses, and still profit. Whereas if you're already starting off at that 70% LTV and above, which I don't recommend anybody doing, you don't have the margin there. You don't have the safety. And at that point, that's, you got to have some skin in the game. Make it hard for that borrower to walk away and lose your money is what I like to say. If you've put your money in that situation, then that borrower walks away, then you can get mad at the borrower, but at the end of the day, the lender agreed to put their money in that risk. So always demand that they have some skin in the game, except in those rare instances where the LTV is just so low that it's a no-brainer to go ahead and loan all the money for the closing costs and everything, so you can get some interest or points on it. But yeah, demanding the skin in the game, obviously, make them bring points to the table. Always have them have enough money for the borrower to do the first round of repairs so that they pay for it out of pocket. They can pay their contractors themselves. And then once the first stage, that first phase of the repair is complete, then you go out, they can come back to you for that draw. You can have the house either look at it yourself. I would recommend having a third-party inspector just to go out, look at the work, and confirm that it's been done to an acceptable, standard, whether that's, with city permits or, building code, whatever, if it's electrical or plumbing, whatever those repairs may be. If it's just flooring, paint, roofing, that's a little bit easier, but always makes that borrower, they have to pay for that first round up front, and then you can reimburse them, and they can use that your draw to pay the second round of repairs. Borrower needs to bring cash to closing. Like I said, with a typical loan to value of 70%. So that's, if that's quick, if the ARV after repaired value is 100,000, then my loan to that borrower is not going to be more than 70, purchase and rehab at the most. But if it is at 70, then I'm not bringing any other funds to the table. They're going to have to pay for the closing costs, pay the points, and go ahead and have all the insurance policies put in place. And another thing I like to see when I say skin in the game is I like to make sure the borrower has enough reserves to pay interest for the duration of the loan. So if there is a 6-month loan, for example, and this is going to be a flip, then let's say the interest only is going to be $400 a month. Then I want to see $2,400, $2,500 in an account, cash that's sitting there, not in an IRA, but a cash account, to where they can at least make the monthly payments on the interest only. And that's not it's not a fail safe, so to speak, but it does show, people who have their stuff together and are organized tend to be better borrowers. So if they come into the game having everything ready to go, it makes me feel pretty easy, a lot better. And also I know that, they've got enough at least to pay me my interest only payments for those 6 months. And it's just another way that I like to keep their feet to the fire, so to speak. Make sure that they're let the borrower know that that they're not going to just walk away without losing any money. And that's and I get it as an investor myself. I love that. I love the fact to use somebody else's money. When it doesn't tie up my credit, doesn't tie up my cash. I get it. I completely understand. But again, I'm coming from the perspective of keeping my money safe. And as a private lender, there are two ROIs. There's the first and foremost is the return of the investment. So if I'm going to loan you $1,000, I want to make sure I'm going to get my $1,000 back. Then there's the return on the investment, right? Is how many points did I get? What was my yield, right? Was it 8%, 10, 12%, whatever it was? So for me, it's always, I want to get my original investment back before I worry about how much money I'm going to make by lending my money out. And so the ROI, not letting the borrower walk away is without them feeling some pain, is a great way to make sure that your first ROI, your return of investment, is going to be more likely to happen. Okay, number 4, and this, people are going to think that I'm a lobby for the title company, but I'm not. I'm just a firm believer in that you don't lend money without a title company. You certainly don't give any money to the investor outright, because if the paperwork's not signed and they have your money, then they can walk away from it. So at least with a title company, your money is held in a third party escrow account on your behalf. And you basically, after everything is completed, all the paperwork is signed, and that that borrower is now on the hook for that money, then the money changes hands, leaves that escrow account, and funds the deal. Another reason is I like to have a lender's title policy usually it's just for the loan amount. I like to go up a little bit more. It's title insurance is relatively cheap. I like to put a 15%. It's also regulated by the state, which is good. So no matter what state you're in, it is going to, most the Texas Insurance Commission, for example, will handles or oversees the fees, the premiums and whatnot. But I like to get a little more. So if I have $100,000 loan, I like to get $110,000, $115,000 on that policy, just in case anything goes south, that there's any kids or heirs that come back after the fact that say, you sold grandma's house without, I'm an heir, et cetera. It protects your funds. And, a lot of people say you don't need it because all title insurance does is make sure the title company did their job. Well, you don't need it until you need it. And it's best just to go ahead and have it, set it up. And so if something does happen, that you are prepared, you're prepared, you'll be covered. And it's, like I said, it's cheap insurance against unhappy heirs and mistakes. And the best thing is your borrower pays for it. You're not, as a private lender, you're not going to pay any of these fees. You're going to pass these along to your borrower. And also I personally like to hold my loans for the whole duration, but if you're more into originating loans and then selling the paper, closing out a title company with a title insurance policy makes your loan more marketable. At least they know that it's gone through the third party process, it's closed, and there is a legitimate and valid insurance policy tied to it. So that is why I don't close at the kitchen table, and never ever give money to a borrower directly on a deal. Make sure it goes through escrow or a title company. Or I know in some states they close at attorneys' offices, sort of interchangeable for those not in Texas or have that type of situation. It's interchangeable, but you want to close with the third party escrow account with your money in it, and you want to get a title policy. That's the first line of protection for a private loan. And going to jump into mistake number 5 here, and not demanding hazard insurance policies. At a minimum, we just talked about the title. That's your first line of defense, title insurance. I like all risk hazard, homeowners insurance, dwelling insurance. Like we're in the Gulf Coast of Texas, and our neighbors in Louisiana know all too well what can happen from June to November every year. Ida just came through and hit New Orleans. So at a minimum, as I'm in the Gulf Coast, I have the homeowners or the dwelling policy, what we would consider a homeowner's policy, a windstorm, and I also demand flood insurance simply because I want to say 80% of people affected by Hurricane Harvey in 2017 did not have flood insurance. And so, and a lot of these houses were, neighborhoods that have never flooded before. And like you can get into the whole global warming debate, real, not real, doesn't matter. As a guy in the insurance industry, I can tell you catastrophes, natural disasters are up, especially in the coastal areas. And so these should be considered mandatory policies. Start with title. Also, your hazard insurance, all risk hazard, windstorm, and flood. I do recommend people in California have seismic just because that's a risk that is very real. However, I understand that seismic is extremely expensive in California, and most people don't carry it on their personal residence or their investment properties. So that could be a whole other webinar in and of itself. But the other thing I like to do is make sure that your self-directed IRA, or maybe it's your SEP or your HSA account, whatever your account is, make sure it's named as the mortgagor or the lost payee. That way, if there is damage to the house, the check has to be signed by the borrower and then come to you before the funds can, and you have to endorse it before any funds can be dispersed. And as the lost payee mortgager, then you also have the ability to inspect the property as repairs are made to make sure that it is brought back to the condition that existed prior to the loss. I know a lot of folks look at insurance money as a blank check and, well, I'm not going to fix this. I'm not going to fix that. I'm just going to take the money and run. That's the beauty of having the first lien and being the loss payee, is you have control over that process and control over the money, the funds, insurance proceeds that will pay for that process. And one of the other folks, a mistake is they don't follow up to ensure the policies are kept in force. Some folks will buy, for example, insurance and then drop it once it's closed. And as long as you're listed as the mortgagor or the loss payee, then by law, the insurance company is supposed to notify you if the policy has been canceled or has lapsed. And that doesn't always happen. Insurance companies are, they're filled with humans, and as much automation as we have, some things do get through the cracks. So I personally like to look and just pick up a phone and make sure that insurance policies are still in effect, or have the borrower, send me the new declaration page once the policy renews. But the scope of this is hazard insurance. This is the beauty of a self-directed investment in real estate, is, there aren't hazard insurance policies for stocks, bonds, or mutual funds. And so you can mitigate risk against the property that is securing your loan. It's one of the beauties of private lending that you just don't find in other investments. And I'm gonna take a quick swig. And along those lines, a lot of folks don't don't demand the use of a note servicing company because it costs extra. Again, those fees are passed on to the borrower. And when it comes to private lending, they say private lending is passive, but if you have to service your own note, it doesn't take a whole lot of time, but it's not really truly passive. You fill out a little paperwork at closing. The borrower fills out some of the paperwork. The borrower cuts the check to the note servicer. They take their fee and then send the rest of the funds to my IRA at Quest. And they make it pass. They collect and they pay the lender. They send notices of default. The key is they manage the amortization schedule. I tend to do interest only, so there's no amortization. It's just the same amount every month. However, I have done loans that were amortized, and they take care of all that. So if the borrower is in a position to refinance and needs to know the payoff, I don't have to go back and start doing calculations. The note servicer can do that and kick out in a schedule of when it closes, how much would be owed. And to me, that is worth the anywhere from $15 to $35 a month that they charge for that service. Is definitely worthwhile, and it helps keep private lending, passive. And again, it's vital if you want to sell the loan, because if you service your own loan, then it's your records. But it looks better, especially if you're selling paper. It looks better to have an independent third party be the one to collect the funds and to keep track of, much like a rent roll in an apartment complex. There's a payment history from a third party. It's independent from you and independent from the transaction, and will help to go a long way to, if you want to sell that loan or a portion of that loan, a series of payments. It puts comfort into the note buyers, the end note buyers' hands, oftentimes. So yeah, I would definitely, using a note servicer is worth it. Absolutely. Mistake number 7, not understanding the foreclosure process in your state. And that means from a timeline perspective, but also from a cost perspective. So in Texas, foreclosures anywhere from $1,600 to $2,000. The last one I did was a year and a half ago, just before COVID, or I guess 2 years ago now. It was $1,800 to foreclose on a property. That was the attorney's fees, but it went fairly smoothly. I just had to, and once I started the process and paid them, I just got email updates. And then once the foreclosure was complete and the house was, repossessed at that point, it certainly made it more passive for me. But I had to do my research and understand, first and foremost, how many days late can I send the intent to accelerate the loan? need to know what constitutes default. There's late payments, obviously, or no payments. Non-payment will constitute a default, but you can also put things in. If a certain timeline is not agreed to, if a flip house is purchased and no work is done on it within 90 days, that can constitute default. Talk to your attorney, but you can put other triggers in there. If the house is used for crime, so on and so forth. But find out what constitutes default for your loan and what's legal in your state. Right? What's the timeline of action? If they miss one payment, can you go ahead and start foreclosure processes? I like to tell people, as soon as you have a trigger for default, to start the process, because it's always easier to stop it at the last minute. At the county courthouse steps, so to speak, you can stop a foreclosure immediately. It's easy to stop. It's not always easy to get the ball rolling in a timely fashion. So I err on the side of caution. It's your money, protect it, but understand that the timelines in your state. How long? And once you do send the notice of default, when can the property go against or go on the courthouse steps for sale? And what are the costs involved? Like I said, my last foreclosure cost $1,800, and while I hate to see that outflow go, $1,800 out of the account, well worth it. Got the house back, made profit. So I got both ROIs. I got the return of my investment, and I also got the return on my investment. Just didn't know it was going to cost $1,800. However, and I may be jumping ahead of myself. If you demand enough points up front, you can have that foreclosure money in your IRA, your self-directed account already, because you got to be careful about commingling, right? So if you loan everything out of your IRA, and jump in if I'm incorrect here, but once you loan everything out of your IRA, if you foreclose, that attorney has to be paid out of your self-directed IRA. And if you've already put your maximum contributions for the year, you can't write a personal check to that attorney to foreclose. So the money's got to come out of your self-directed IRA if it owns that note. So this way, you collect enough points. So in my case, it'd be at least $2,000. That goes into my IRA. It's already there in case I have to foreclose. It's not even a consideration of how much can I put in or can I make any additional deposits. It's a no-brainer. It's already there, and the borrower has paid for their own foreclosure up front. Again, average cost in Texas, I put it at $1,800. That's what I paid 2 years ago. So let's just call it an even $2,000. Since everything is going up in price, including houses, let's just call it, maybe I should change that to $2,000. But it's a good strategy to go ahead and have that. And again, that is charged at $2,000 of the points to cover the foreclosure. That way you don't commingle any funds and you don't do any prohibited transactions. Juan, you didn't jump in, so I guess I'm not out of bounds there.
Oh, sorry, I put it in the chat box, but yeah, you are correct. You're not out of bounds.
Okay, cool. I'm sorry, I couldn't see the chat. All right, cool.
Yeah,
all right,
good.
Yeah, I figured if I said something incorrect, you'd jump in. So just want to make sure I'm still within boundaries. Okay, so that's number 7, not understanding the foreclosure process. Number 8, I see this a lot. People consider jumping into a junior lien, a second position. A prime example, a lot of times you hear, especially newer investors, where they've got the hard money loan for the acquisition, the purchase, but the hard money lender won't give them money for the rehab. And so they want, would you be willing to loan in a second position for the rehab? And it's absolutely not. If you're starting off and if you haven't done 50, 100 loans, stay away. Stay away from that, because there's a reason the hard money lender is not giving them the rehab money. It's the margins are too slim. So if a hard money lender is not going to loan on a project because the margins are slim, and they do it for a living, then neither should you as a private lender investor. That's just a quick rule of thumb. Can you make money in seconds? Absolutely. I know people who'd make a killing in non-performing seconds at that, performing and non-performing. However, you got to know what you're doing, and it's really easy to slip up, especially early on. And that's why I just tell people, just make it a habit to avoid second position liens. Like I know there are some very successful folks in Houston that flip in some very nice neighborhoods that use this model. And I'm not saying don't invest with them. I'm just saying I wouldn't do it until you're comfortable. You have a full understanding of what that second position means. How you can get easily knocked out because it is very, I've had my money held hostage in second position liens. I got my money back and I got both ROIs ultimately, but it took a lot longer. So there was an opportunity cost that I lost with that money. But then, to my point earlier, I've had a friend walk away with $18,000 in my Roth retirement. And it was bad because when I did talk to the first lien holder, they wanted an additional $54,000 to make the loan for me to bring the loan current and to take over the property. And unfortunately, it just wasn't worth it. One, two, I didn't have the 54,000 I was all loaned out in my all my Quest accounts, even commingled with the wife and kids stuff, and I just didn't have it. So I ended up losing it, going back to trusting the borrower. And getting into, this is where I commingled. Mistake number 2 and number 8, jumped into a second position lien, didn't trust the borrower, got wiped out. And one thing that would have helped me is if I would have been honest with myself and do I really want the property if I had to foreclose? And the truth was no. At the end of the day, it was, well, let's just say it was a POS, and I'll leave it to your imagination to figure out what that acronym means. But yeah, at the end of the day, I really didn't want the property, but I loaned on it anyway in a second position lien, and which was just not wise at all. And the cost to bring the first lien current was more than I had, more than I could do, and was more than what the property would have been worth. It needed so much work to bring it to a sellable condition. Even in a wholesale position, it wasn't. It was too much money. I would still, lost a significant amount of money. So I just. I figured it's better. 18 was the least amount I could lose. So I just took my lumps and I moved on. But that was, jumping into a second position lien, not understanding it, not understanding the risk that was involved, and trusting the borrower. Okay. Number 9 is allowing the fragrance of higher entrance to cover the stench of risk. I see this a lot. People will agree to a loan, for example. Let's say, it's it's $70,000 all in, $100,000 ARV. So there's 50 to 55 to purchase the property, and then 15 to renovate. And then all of a sudden the rehab budget comes back and they want another $10,000, which now you're at 80% LTV. But the borrower says, well, I'll give you more interest. Well, that's great. You're getting more interest, but you're also well above a threshold of safety now. So when I say that fragrance of higher interest, don't chase risk with interest. Demand that they increase the skin in the game, and if they don't close, they don't close. But there's no sense in chasing, throwing good money after, potentially bad into a very risky situation. To where now, if you're all in at 80%, and let's say they don't complete the rehab as needed, and you take over, and even to wholesale it, you start doing some simple math, and if you're at 80% LTV, there's not a whole lot of room in there. You're going to have to hopefully, wholesale it if you can get retail. But it's you put yourself into a very precarious position, all because of I can get more interest. But I would highly recommend against that. I would go for lower the LTV and make sure keep the interest and the points the same, but demand the borrower bring more to the closing. And this, again, if this guy gets in with your money, 80 grand of it, and something goes wrong, he walks away, and now you've paid $80,000 for a $75,000 house or an $80,000 house. Your margins are gone. So I'm sure there's a better way of saying it other than allowing the fragrance of higher interest to cover the stench of risk. But hopefully that gets the point across. Once you've made your loan and you've agreed on your terms, I would, unless the LTV is just so obscenely, if it's a 30% LTV and now it's 35, obviously you still got plenty of margin to protect yourself for both of your ROIs. However, at this point, when you're already at the max end of that spectrum and more costs are going to come in, and it's going to happen. Sometimes, termite damage doesn't come up initially, right? There may be other damages. These things, do happen, but hopefully your borrower has a contingency already built in for such things. And your LTV is going to be that. I like 65% personally, but no more, absolutely no more than 70%. And so don't chase the, higher interest. is the moral of that one. And then mistake number 10 is no FU. And before people get offended, that stands for follow-up. And it's quite simple. Is private lending is a passive investment, a passive activity. However, it still requires activity. It requires you to do something. You have to, no investment is truly passive. Their time and effort have to be spent in it. And since this is your retirement and I want you to keep it safe, then I highly recommend and demand you follow up at least once a year just to make sure that everything is running smooth, right? Make sure the taxes are paid, property taxes, because yes, while we have first position liens, federal and state local governments can come in above us, especially if no taxes are paid. Again, to the previous point, you want to make sure your insurance premiums are paid, and that's so I like January is a good time, or February is a good time to make sure that taxes are paid. They're usually due at the end of January, so by February, March, I like to make sure those taxes are paid, insurance premiums are paid, but also you want to make sure that they're paying any HOA or MUD or any other encumbrances that need to be paid on that property. You want to make sure that those obligations are being met by your borrower in case you do have to take over the note in the property. At least you're not starting with an arrearage. Also, if they don't pay taxes and premiums and whatnot, again, depending on your notes and your wording in your state, that could be a trigger for default. So you definitely want to get ahead of the curve before the county owns the property that your investment is tied to. So always follow up at least minimum once a year. Around February or March is usually a good time when you can go online and just check. Since this is also something virtual assistants can do, or if you're in a position in your day job, you have somebody that could do it for you, it's even better. But have it done, follow up, make sure you do the FU, do the do and do the FU, follow up, and that's going to do it. Here's a little recap of the 10 mistakes. Not believing you can do it, trusting the borrower, not demanding the borrower has skin in the game, not closing at a title company, getting a title policy, not demanding hazard insurance policies, not using a note servicer, not understanding the foreclosure process, jumping into a junior lien, allowing the fragrance of higher interest to cover the stench of risk, and also not doing your follow-up. And that's going to do it's for my presentation. Here's if anybody wants to get a hold of me, you can contact me at email me, keith@privatelenderpodcast.com. You can also go to privatelenderacademy.com. There's some information, or Private Lender Podcast is available, privatelenderpodcast.com, and it's available on iTunes, Google Podcasts, Spotify, pretty much anywhere you listen to podcasts. It's you can listen to it. And so if there are any questions, I'll be more than happy to take some right now.
Well, thank you so much. That was very informative, and we absolutely have questions. Do you lend for new builds?
I have not. I've been approached on some new builds, but I had the new builds in question. I simply didn't have the funds. They were, they needed about $300,000 just to build. They were building some massive homes. So I turned them down because I couldn't fulfill. I didn't have the money to do it. Again, the one downside of private lending is you run out of your own money at some point. And so in my case, my opportunity to loan on a new build was not I wasn't able to do it. But yeah, I absolutely would loan on a new build. That is something that does intrigue me, because there are some safety aspects already involved. You're improving the property, so as far as margin, new builds can be a good spot.
Okay, thanks so much. The next question is, why don't you like to see the interest reserve in an IRA, especially if I'm over 50 and a half?
Okay. So I understand. Okay. So the interest reserve, I like to see that. It can be in an IRA, but I like to be able to see it in cash. Just a lot of time, if it's in an IRA or say like a 401k, there can be some encumbrances to getting that money out to pay. So I like to see interest reserves. Now, if the IRA is the owner, is the lender. I'm sorry. Let me back up. If your IRA is the borrower right, then you have to have that money in the IRA to pay the interest, right? That's part of the IRS rules and regulations. I'm normally not lending to another IRA that's purchasing a property. I'm normally lending to an LLC or an individual. So I want to see that. I want to see that money in the individual's hands or the LLC's hands, and not, in somebody's retirement account that they would take a penalty if they had to go access those funds. They'd have to take a penalty. Whereas if your IRA is the borrower, then it would absolutely have to be in your IRA account to be able to pay the interest.
Okay, perfect. Thank you so much. Let's see. We have one more question. Let's see. What are your typical terms and would it vary?
Absolutely. So typical terms, I like to tell people none. I don't have any. I look at everything on a case-by-case basis. But my terms come from the 3 Ps, the person, their process, and then the property. So the beauty of private lending is it starts with a personal relationship, one-on-one with an individual, whether meeting at a Quest event or a RIA event, or in my case, I went to RIA events and I looked for the whales. I looked for people who'd been doing this for a long time. And I basically offered them, I said, look, I will loan you money at 8%, but I want to earn while I learn. So you're going to walk me through your process, whether it be a flip or an acquisition loan that the borrower needed to own the property for 6 months before the bank would consider a commercial loan on it, for example. That was a commercial property. But I lowered my rates to 8%, and that was more of the owner finance model. But 8% was extremely attractive to real estate investors. It got me at the top of the list, and I found that most folks don't mind sharing their knowledge of their process. And when I say, so the personal relationship with the person, their process, right? If I'm going to lend a flipper money to go flip houses, I'm not going to lend money to a landlord to go flip a house. That's why there's hard money. Someone who's brand new, again, there's hard money. I want to see seasoned folks. And I don't want to chase inexperienced. I don't want to chase that risk with higher interest if it's inexperienced. If it's an inexperienced person. So I started off at 8. To get to the question now, I like 10 to 12%. 12% is great. It's easy math. There's 12 months in the year, so it's just 1% a month basically. You think of it as 1 point. I personally, if you looked at my college transcript, you would not believe that I have anything to do with lending or finance because I was horrible. But that's going back to mistake number one. It can be done if a knucklehead like myself can do it and do it successfully. Then trust me, anybody can. But I like that 10 to 12% in points. I like points. Right off the bat, it lets me know that they've got skin in the game. So, like I said, I kind of go with the rule of 2 points. That'll cover my foreclosure. And then, that sort of that 10 to 12% is sort of my normal guideline. But it also depends. Quincy Long has this great, when we're talking about usury, you can't go above 18% in Texas and you need to check your state. But Quincy has this great line in one of his classes. He was like, what's a little usury amongst friends? Like, what's the big deal? Right. Like if someone's willing to pay me 25%, then I should, on a business loan, which it's an investment loan. It's not a consumer loan. Then it should be okay. But we've got to play within those boundaries. But, I'm certainly open, depending on that person and their process and what that condition of the property and what's going to happen. I'm certainly comfortable in that 10 to 12%. And I'll even go higher depending, if there's going to be no payments for a while, which always leave yourself a trigger for default. And Quest teaches that. However, there are some times when you may be in a safe position to go 3 or 6 months without, collecting anything and still have a strong position to foreclose if need be. But if that means you can get 18% on the back end and you're not, sacrificing any risk, then, what's wrong with that? So, in short, if anyone's charging more interest than I am, I want to know about it ASAP. I want to know who they are, and I want to beat them to the punch.
Wonderful.
I hope that answers the question. But I like the average of 10 to 12%, but it depends on the situation. I look at everything on a case by case basis.
Perfect. Well, thank you so much for being with us here today, Keith Baker. It was an amazing presentation, lots of great information. For those of you that we did not get to your questions, I'm so sorry. Oop, There's our light conserving. But there is Keith's information up on the screen, and I put our information in the chat box. So please reach out to us if we can do anything for you. Thanks again for joining us at our weekly seminar. We will be back on Thursday at noon Central. Have a wonderful afternoon, everybody. Thanks so much.
And let's see, stop share and leave.